Welcome back. Well, it's back to reality. Well, my kids are off to school and college, so September is when things get serious again. So we had basically in August with lots of volatility. I mean, the price change actually was only negative 1% for the whole month. You had some pretty extreme ups and downs, 3% up, 3% down, and we kind of finished into the long weekend with a rally. If you remember, we had said an important date was September 1st. That was basically when the new tariffs would hit. There was some expectation in the market that maybe there would be some deal or at least some notion that the various parties would be sitting down and actually negotiating on the weekend. And that's really why the market is selling off today. But again, it's the same old story. So tariffs matter. The markets don't like this long-term tariff tussle or tariff war. It certainly will affect the economic environment. Risks are elevated. That hasn't changed. There's a lot of policy concerns that are in the mix right now. In Europe, things are heating up with what Boris Johnson is doing. Today, he basically is forcing an election. This will probably happen before the date in October comes around when the Brexit deadline basically is going to occur. So things are coming to an ahead everywhere. I mean, there are the demonstrations in Hong Kong. A lot of market watchers and economists are looking to that situation sort of as a black swan, a potential black swan event. So there are lots of things going on politically around the world that we need to be watching. The yield curve continues to be inverted. The longer that goes on, basically that's a pretty strong recession signal. You have to understand in that context, though, that it doesn't immediately translate into a negative equity markets. Typically, you get something like 20 months or 30 months or even 40 months of good equity behavior after inverted yield curves. So it's not an immediate event that once you have an inverted yield curve that you go into a bear market. We saw that in 2006 and 7, even going into the big recession at that time, yields inverted way before things started getting really ugly in the equity market. So the other area we like to look at to see if there are signs of danger is the credit market. If you look at BAA spreads, they're only at about 230 basis points. That's not bad. So there's no sign of credit upheaval yet. And typically, if spreads widen to 3% or 4%, those would be signs that something is really going off the rails. In terms of asset classes, gold continues to break out, so you get a lot of flight to quality or flight to risk-averse assets. Gold is one of those. The dollar is actually the trade-weighted dollar continues to go up. That's really the flip side of the Chinese currency going down. That's part of the currency war that we're in, where the Chinese are trying to offset tariffs that are being imposed by us on their goods. The problem now is the Chinese are also putting tariffs on our goods that are being imported into China. So, this is like the worst of all worlds when it comes to economic activity. So that's it on the macro front. We will be watching all of these things in September and October, and September typically is the worst month for the stock market. October, November tends to be the best. So, expect a lot of volatility in September. On the micro side, during August, the best performers, if you're just looking at our our portfolio. The top 5 performers were American Tower, Crown Castle, CVS Health, Costco, and Alibaba. It's interesting if you look at the mix of stocks, American Tower and Crown Castle, these are obviously cell phone tower companies. There's a lot of recurring revenue there. That's something the market likes right now, and utility companies. CVS Health is a stock we recently bought. That's a turnaround story. They're reinventing themselves in the healthcare services space. Costco, very interesting, is making a new high. That's also, if you think about the market liking recurring revenues, obviously the Costco business model is to make money not on the margin or the profits that it earns on the goods it sells, but the actual fee that it charges its club members. It's interesting, Costco opened its first store in China, and I don't know if you saw the pictures of that. That was pretty impressive, but the stock just went to new highs when it was clear that the Costco store opening was very successful. So maybe that's a lesson for policymakers that maybe we should compete in China rather than protect. Companies like Starbucks and others are doing very well in China. So one of the key ways to fight technology theft and things like that is by making technology obsolete. That's typically a better way to get ahead of your competition and players that are somewhat unfair when it comes to technology transfers and so forth. So that is my advice to policymakers. On the bottom, the worst performers in August were, from the top down, were Ulta Beauty. Unfortunately, on Friday, Ulta Beauty kind of dropped a bomb on the market by saying that the makeup segment across the board slowed dramatically in July and August. That was very surprising, but because typically makeup is a very kind of almost recession-proof segment. So it was very surprising that across the board, and we saw this amongst their competitors as well, that there was this incredible deceleration in makeup, and especially in the high end. So we're really scratching our heads here. Is this telling us something about the consumer? Consumer confidence levels are still very high and very bullish, pretty much in line with where the stock market is. I mean, you have to remember the stock market is still up about 16 or 17% year to date. So that's a pretty, these are pretty lofty levels here. So the consumer is employed, the consumer has a wealth effect. That all translates into pretty good consumer sentiment. So it was very surprising that Ulta basically guided down, Ulta Beauty guided down from 6 to 7% same-store sales going forward to 4 to 6. 4 to 6% same-store sales is still incredibly good. If you think about your typical retailer has sort of 3 to 4% if you're lucky, if you're a good one. So the stock really got punished and took away all of the profit that we had in the stock for the year. So we're kind of reassessing that position at the moment. Other stocks that didn't perform in August were Palo Alto. Palo Alto is a cybersecurity stock or software company. They are going through a transition also similar to some of our other software companies like Autodesk and previously Adobe, where they're converting to a cloud-based delivery of their software. And that typically, if you think about how that works, you go from fixed contracts to online subscription models. So you kind of lose near-term revenues, but gain long-term subscription types of revenues. So there's some choppiness in their numbers, and I think that's why the market is a little bit cautious on Palo Alto. Our view on Palo Alto is a little bit of a longer view. Cybersecurity is obviously an area where expenditure amongst corporates is going up. If you look at surveys on expenditure trends, that's the area where there's the most gains in cloud computing expenditures, so we want exposure there. There's a question whether Palo Alto is the leader in that space. Obviously, if you look at how companies are attacking cybersecurity, there are many ways to do that within the network, either on the software side or on the network side. So Cisco's in that game as well. But we think Palo Alto, given its recent acquisitions, and that's one of the only reasons it actually missed its earnings per share the last quarter, because it made two very prominent acquisitions in their space, which we believe will have longer term benefits. So we continue to be patient with Palo Alto. It's not a cheap stock. None of these stocks are cheap and will ever get cheap unless we get a bear market. Sometimes you have to be patient. Bank of America is another underperformer. So the banks have continued to have a terrible time with the inverted yield curve. That's something that's obviously hurting them and won't change until we get a more level or flat or normal yield curve. Other stocks that have gone down are Regeneron and Corning. Corning is I think with the tariff warfare, given they produce a lot of their glass in Asia and so forth, is also part of this tariff issue. Regeneron is a more risky biotech stock. There's a risk-off tone to the market. We like Regeneron not because of their two current drugs, but because of their pipeline. So we think we should be patient there to see when and actually anticipate when these immunotherapy drugs will be released. So in a nutshell, again, this is a highly risky environment currently, given all the policy things going on in the world. My personal view on the tariffs is that Trump will sit down with the Chinese at some point, probably sooner rather than later, to get some sort of progress with the tariffs. This doesn't mean we're going to solve all of the issues that are so important regarding tariffs, but I think this is a market event, and we shouldn't be running for the hills here and think that nothing will happen on tariffs. I mean, Trump's entire political future, if he has any, rides on this issue and rides on the economy. So it's doubtful that he will put the economy into the tank just because of this entire tariff situation. So that's my personal view. That's why it's important to remain invested in stocks. I mean, if you look at the fundamentals, the fundamentals for equity still outweigh bonds, given the low interest rates. But we've become a lot more cautious in the portfolios. We've reduced equity exposure in our balance accounts, and we've emphasized recurring revenue type generators in our equity portfolio. So that's really our marching orders for the next month. I will see you next week.